Good afternoon,
Very clear.
Quasar Markets Live. I am so happy to be here with Dr. Alan Ellman, the president of the Blue Collar Investing Corp. Dr. Ellman, how are you doing today?
Morning, Howard. Everything's great down here in sunny Florida.
Glad to hear it. We're in snowy Ohio where I am, so not as well there. For those that haven't been following, Dr. Ellman is an expert with 30 some odd years experience of doing covered call writing, and he's been doing a series with us, walking us through some of the strategies, some of the things that he teaches his clients. And today I asked you a little bit to talk about because as we were talking before we came on here, you usually discuss when you discuss your strategy is it being a sort of lower risk than even just buying a normal stock. But you have different levels of risk, within the trades that you make. So I thought it'd be good if we could talk a little bit about that and you could give some examples of it.
Sure. This is a very important topic that you suggested, Howard, because most covered call writers and sellers of cash secured puts believe that there's only one way to handle these strategies. For covered calls, it's generally writing a call strike slightly higher than current market value of the stock. Now, if you go back and look at all of the formulas that different strategists use for covered calls, it's always slightly out of the money, one or two strikes higher than current market value. You sell the call and then you hope for the best by contract expiration. However, there are a lot of factors that we need to consider when we're selecting the strike. For example, what kind of market are we in now? Is it a bull market? Is it a neutral market? Is it a bear volatile market? That's factor number one. What about the chart technicals of that underlying security? Is it all bullish? Is it mixed? Of course, if it was all negative, we wouldn't use that security. And also, what is our personal risk tolerance? It's not the same for every investor. So some investors may be willing to take on a little more risk than others. And then finally, what is our goal? We have to identify our goal. Is it, for example, if you're doing monthly covered calls like I am, my goal is 2 to 4% a month as
Right.
my starting point. In my mom's account, I do 1 to 2%. Some people are more aggressive. They'll go up 6 to 8%. So all those are factors in determining how we craft our trades.
Absolutely. And like you said, it's not a one size fits all. And that's what I've really liked about the more I've got involved in your strategy and your systems that you have at the Blue Collar Investor is that you really do, while you spend so much time fine tuning the program, you've also spent just as much time looking at the different ways that you can trade it for the people that have a little bit more risk aversion versus the people that are a little bit more risk on. So again, I'm very impressed when we do it. Um, you know, and I think it's important to explain to people because it is, so many of these different systems you see out there. Again, we were talking before the time are really just copy traders, and what you guys are not is a copy trade company. You're a company who teaches people how to fish, and I think that's the difference when it comes to what I've seen in your programs, and not just that, but that you have fine tuned it for all the different sort of scenarios that come up, and that you don't just rest on your laurels. You look back at almost every trade, winners and losers, as you brought up, to see what could you have done different if you had adjusted this way, if you had done this, where could you have maybe eked out more profits or lowered your losses. So again, I do think it's amazing the way you guys have put this together.
Yeah, I appreciate that, Howard. It's everything in the BCI methodology is based on my personal experience trading over the last 30 years with these strategies. So whenever I made a trade that was a loser, I said, how could I have improved on that? Is there a way I could have turned a loser into a winner? And even with my winners, is there any way I could have achieved an even higher level of success? And all of that is integrated into the BCI methodology. So as far as aggressive versus defensive, now there are a couple of different types of strike prices we could use with covered calls, as you see on this
Right.
current screenshot here. And using what's known as an out of the money strike, which means that we're agreeing to sell our shares at a higher price than current market value, is what I would categorize as a more aggressive approach to covered call writing. But yet, that's the one we'll be using most of the time because it gives us the opportunity to generate two income streams per trade.
Right.
Number one, from the premium, and number two, from share appreciation from current market value up to that out of the money call strike. The other strike that we're going to discuss today is the in the money strike, where we're agreeing to sell our shares at a lower price than it's currently trading for. And that will create a premium that has two components to it, as we'll discuss, an intrinsic value component and a time value component. So our break even price point is lower, greater than the out of the money strike. So that's the type of strike we would use as a defensive approach to covered call writing, perhaps in bear and volatile markets. So, what I did when you suggested this topic was to provide some screenshots with GCT with some real life trades. But first, if it's okay, Howard, let's
Yeah.
let's discuss the moneyness of call strikes
Sure.
for in this hypothetical, and then we'll get into a real life example.
Great.
With the stock trading at 48, we'll talk about the various call strikes. Okay, so the moneyness of a call strike is the relationship of that strike price to the current market value of the stock. And let me define the current market value, because let's say we bought Apple at $100, and today it's trading at 240.
Yep.
Well, when we enter our purchase price, or the price when we enter a covered call trade, it's not 100. It's what it's trading for at that point in time, so we could appropriately calculate our returns. All right. So when I say current market value, that's as of the moment you're executing the trade, not at the time, for example, that you bought the stock.
Right.
So here are the different types of strikes. With the stock trading at 48, an out of the money strike is higher than 48. Let's say it's 50. We have the stock at 48, we sell the 50 covered call. Now, that total premium is all time value, and that time value is based on the time to expiration and the implied volatility of that underlying stock. So stocks that are much more volatile, let's say NVIDIA, would have a much greater time value component than a snoozer
Sure.
stock, like let's say Con Ed, would have a much lower implied volatility, and therefore the premiums would also be lower. Now, very closely related to the at the money strike is what's known as uh, the near the money strike. So,
Right.
for example, with the stock trading at 48, an at the money strike would be 48. But if it was trading at 47.96, that 48 strike would said to be near the money. Now, the in the money strike, and we're going to focus in on out of the money and in the money, that's where the strike is lower than current market value. So with the stock trading at 48, let's say we sell the 45 call. And let's say we sell that at a premium of $4. Now,
Okay.
can we count that $4 as total profit? The answer, of course, is no, because we're losing $3 on the sale of the stock. If we own it at 48 and we agree to sell it at 45, well, we're minus 3. We're devaluating that asset for $3 of premium. Now,
Right.
that $3 is known as intrinsic value. The amount, the 45 strike, is lower than current market value of 48. That, Howard, is not profit. So if we received a $4 premium, $3 component of that is called intrinsic value, not profit.
Yep.
And the remaining $1 is time value. That is our initial profit. Now, the one thing I want to let your viewers know is that all the spreadsheets created by BCI will break down the components of an in the money strike into intrinsic value and time value and calculate the initial returns based on the time value component only.
Right.
Now, here's the main point regarding in the money strikes. Because there are two components to an in the money strike and only one to at the money and out of the money strikes, your break even price point is the lowest. And that's why it's a great opportunity in bear and volatile markets to use this in the money call strike.
Absolutely. I could see where the profitability there because you're going to get a lot more premium as a total number, even though you know part of it, like you say, intrinsic versus the time value, more bang for your buck, so to speak.
Well, the time value profit will be the same, but what you're doing is you're trading in protection to the downside in exchange for the opportunity for share appreciation. So the benefit of the out of the money strike would be the two income streams.
Yeah,
You know, if you're capturing dividends, make that three, right? In return for that insurance policy for the downside protection.
yeah,
So the out of the money has the advantage of two income streams. The in the money has the advantage of additional protection to the downside.
absolutely. So I see you have
So
GCT up
I'm
here on the
speaking.
screen.
Yes, sir. The GCT screenshots that I took on 4/22/24 when GCT was trading at 35.63. So what I'd like to do, Howard, is show you an in the money strike and an out of the money strike.
Okay.
So the out of the money call strike higher than current market value I selected was 40, and that had a bid price of 225. Now, as I said before, that is all 100% time value initial profit.
Yeah.
Now, if we look at the on 5/17 expiration, that 30 in the money strike, lower than current market value, that had a bid price of 690. So keep in mind that that 690 is not all profit. Why? Because the 30 strike is $5.63 in the money. 563 is the intrinsic value component of that total premium of 690. And as you'll see, the spreadsheet will break that down as to what your actual real, not exaggerated, time value profit is.
And that's important to point out because there are so many people that don't understand that that is not profit and counted in as premium as profit. I've seen that mistake made by new traders many times.
Many times. And people call me, Alan, I can't believe the returns I'm getting using these in the money strikes. And I go, hold on,
Yeah.
it's not as good as you think. And then
Right,
I
because for
explain to them how to break it down.
and then they're not
So
as excited anymore, are they?
well, but at least I bring them
But
into
they
the
learn.
real world.
Abs-
I pull them out of the twilight zone and bring them into the real world of options. Because look, let's face it, you really need to know where you stand because there's no free lunch with any kind of trading. And
Absolutely.
with this kind of trading, it gives us the opportunity to beat the market on a consistent basis, but never hitting grand slam home runs, hitting singles and doubles all day long, but never hitting grand slam home runs.
Right. If you are, then you need to look at what you did because you probably didn't follow your guidelines the right way.
Well, I mean, yeah, there's
Unless the
ways of
stock
making
goes up
money
like
on the
Nvidia.
option.
Um, but
Right.
yeah,
And you can
it's
make a lot of money on options, but usually you're incurring a lot of risk. So you have to
yeah.
decide, where on the risk reward spectrum are you? Are you willing to incur a lot of risk in return for the potential of making a lot of money? Or are you willing to incur only a low amount of risk in terms for hitting these singles and doubles like I've been doing now for nearly 3 decades?
Yep, absolutely. And as I've told you, my analogy is always Wade Boggs made a lot of money hitting singles and doubles for the Red Sox and Yankees for years. It's a great way to build up equity and especially to get yourself set up and earn an income stream from your money. Where many people are
Right.
not doing that. So that's what's so important.
Right.
And
Dave
like you
Kingman
said,
hit a
I'm
lot
just
of home runs.
yeah, and it is funny how you have new investors. Though I had a friend who was buying just calls, and it was during COVID when everything was mooning up, and he just thought he was like, "This is I don't know why you guys buy stock. I'm just buying the next week's $5 higher call on Apple, and it hits every week, and I make all this money." I said, "Yeah," until the first week where it didn't hit, and he lost all of his money and didn't realize there was no in between level, so to speak. So that's why
Yeah,
it is important to
absolutely.
explain to people, that they know what they're doing before they hit that button for sure. And as you brought up, and I like to bring up in every session that we have, paper trading always is the way to start with any new strategy.
And that's why educational sites like Quasar are so important to investors because it gives them a perspective that's fair and helps them analyze which strategy is right for them and their personal risk tolerance.
Absolutely. It's not a one stop shop, and there are so many different ways to do this. And so many people that are really successful with it. Not as many as you would think if you watch social media, because it's not all roses and teddy bears. There are bad days, and it is not easy to do. But we try to give everybody the information and the places to go learn how to fish, not just to copy somebody else's trades and hope they work in the right way.
Okay, so here's a screenshot now that I took of GCT, the option chain, on 422 for the, as you see circled on the top right, the May 17th
Okay.
expiration. So it's a little less than a month out. Now, at the time, GCT was trading at 35.63, as I alluded to earlier. So we're going to look at the in the money 30 strike, which had a bid price of 690. You can see in the brown cells on the
Yeah.
top left. And we're going to look at the out of the money 40 strike, which had a bid price of 225. Keep in mind, the 40 strike is all-time value, and the in the money 30 strike is a combination of intrinsic value plus time value. Now, where the red arrow is shows the delta
Yeah.
of 77%. Now, what that means is that there's an approximate 77% chance of that option expiring in the money or with intrinsic value, which is a positive. So that means you will be guaranteed, if that happens, the entire time value profit. You don't want it dropping below that in the money strike. So that means there's a 23% approximate 23% risk factor to this trade. So very favorable trade for investors.
Yeah.
Now, if you look at the 40 strike at 225, I just want you to look at the pink column now, which is the implied volatility, and you'll notice the humongous implied volatility of GCT over 100%.
Right.
And that's the reason why you're going to see very robust premiums,
Premiums.
which also means greater risk.
Yeah.
Once again, the risk of the in the money 30 call, the defensive play, is 23% approximately. So not bad. Okay. So that's a starting point. I believe I created a screenshot of this of the calculations. Okay, so Howard, this is the 40 strike. You can see it on the top row there. The 40 strike, which had the 225 out of the money, all-time value. And then
Yeah.
if you look at the second row, the spreadsheet, trade management calculator, will give us the following information. All the way to the bottom left is 26 days. So if taken through contract expiration, this represents a 26-day trade.
Right.
Now, notice the break-even price point in the yellow cell, 33.38. That is the price of the stock minus the entire premium.
Okay.
So just keep that in mind now, 33.38, and you'll see the difference when we get to the in the money strike,
Right.
which has that additional intrinsic value component to it. Now let's focus on the brown cells, which is what we're all here about, how we're making money, all right?
Absolutely.
So that's why we're doing this. So you can see here that it's a very robust 6.31%, 26-day return, and that annualizes out to 88%. Now, that is very high. And the reason it's very high is because of that implied volatility of
Utility.
GCT. So this is a trade that would be appropriate for investors that are willing to take on a fair amount of risk in their trades.
Right.
Also, an additional component, which will make things even more amazing, is that if you look in the purple cell on the bottom right, it gives us upside potential of 12.26%. What that
Right.
means is, in addition to the 6.31% premium return, we also have an opportunity for another 12% if GCT moves from 35.63 up to or beyond that $40 out of the money strike.
Yeah.
So we have an opportunity for a 26-day return of 18.5%.
Wow.
Now, again, this trade is not appropriate for every investor. You have to be willing to take on a little bit more than low risk. I would
Yeah.
say moderate risk for this particular trade. But this shows you the advantage of using the more aggressive out of the money strike, which we'd use in normal to bull market environments where the chart technicals are all bullish, if your personal risk tolerance allows you to do so, and depending on what your initial time value return goal range is. In this case, it's for the 26 days, 6%. So does that
Right.
meet your goal?
Sure.
For some investors, yes. For some, no.
Absolutely. And now we have up the
Now
defensive.
we're looking at a screenshot for the in the money. And you can see on the top row now we moved from the 40 to the 30 strike, and that had a premium of 690. All right, is that 690 all profit? No, because it has an intrinsic value component. We're going to lose 563 on the sale of the stock. Now, Howard, if you look at the bottom row for the second and third statistics from the left, you see that the spreadsheet breaks down that 690 into a time value component of $1.27 and an intrinsic value component of 583. Now, the spreadsheet will calculate the time value return based on the 127, not on the 690. And in the brown cell, that calculates to 4.23%. And based on that 26-day trade, annualizing out to 59%. So very, very robust returns still. And that does not include the intrinsic value component of 563,
Right.
which is factored in to that purple cell on the bottom right, which says downside protection of 15.8%. Let me explain. That means that if we enter this trade with the 30 in the money strike, we are guaranteed a 26-day return of 4.23% as long as GCT does not decline by more than 15.8% by expiration Friday. Is that not a great trade to make in a bear and volatile market? Or
Absolutely.
if your personal risk tolerance is low,
Right.
let me
It
give you
absolutely.
just a little philosophical
Yeah,
concept regarding
difference
these
between the
interest
two, but
rates.
it shows you, depending and what I like is it provides for two things because your risk tolerance might change as you move from a bullish market to a bearish market. You might have a readjustment, individuals might have a readjustment, so it accounts for that and it gives you a structure to use in either case that allows you to earn money as you still have you've bought downside protection. Other people are looking to buy VIX or some other things, for downside protection. You're doing it within the same stock, making it a lot more, I don't want to say easy, but a lot, you know what I mean? Is it's taking some of the different things out of play, the variables that you have to take into account sometimes when people look at downside protection.
Yeah, one other thing about this downside protection that I think will be of interest to your viewers here is that I look at that downside protection you see in the purple cell there as an insurance policy.
Right.
So it's an insurance policy to that 4.23% initial time value return. But this is a very unique insurance policy, Howard, because it's one of the few, maybe the only insurance policy that we own that we don't pay for.
Sure. Right.
Okay, because that insurance policy is paid for by who? By the option buyer
Higher.
in the
Yep.
form of intrinsic value. So it's a free insurance policy.
That's a
So I
great
want your
point.
viewers to look at it from that perspective.
Yeah, absolutely. Now, do you ever do where you maybe own 200 shares of a stock where you would use multiple different strategies at a time? Where you,
Excellent point, Howard. Excellent. And the answer is absolutely yes. Let's say, for example, that I own 500 shares of GTC. And let's say that my overall market assessment was slightly bullish. Okay, slightly bullish. And let's say the chart technicals lean bullish, but we're not 100% bullish. You know, maybe some of the trend and momentum indicators were mixed. Okay. Well, I might do three out of the money and two in the money, or four and one if I'm a little more bullish. So you can definitely ladder your strikes based on how bullish or bearish you are, or how much of a personal risk tolerance you're willing to take. So that was an excellent point you just made.
Thank you, thank you. I try to bring one to the table every week if I can.
You bring
But this,
many to
yeah.
the table, actually.
I have to say that that's what I love about it is the fact that again, not like a lot of the fly by night programs I see out there that have maybe been put together over the last 6 months to a year, and people haven't looked at all of the different components that go into a strategy. They're just starting to learn themselves. You are able to provide, 30 years, 3 decades of making these trades on your own. And, I'm sorry, I forget, when did you start the Blue Collar Investor?
We started the actual business in 2007.
So, and even there, almost 20 years at this point of, showing it because I think that even is where it takes it to a different level is, I've seen people who were good investors for a long time, but it takes a while for them to learn how to get their education across to their clients and how to tailor it so it's not just made for them. Some things, I'll talk to Steven sometimes about things and he goes so far over my head so quickly because he's got such a feel for things that I get lost and then it takes me a while to catch up. What you've been able to do is bring this down into a way that I think that, any type of investor is going to be able to grab value from it, to learn from it, and tailor their approach within the strategy itself. So it's a couple of things that, again, that I keep pointing to that I think is very different as I talk to lots of educators and look at lots of programs across the nation. This is one of the differences here that you are able, you've done so many of these trades as you talk to, when we talked about assignment and you said, listen, I've done thousands of these covered calls and I can count on this hand basically how many times I've had that actual assignment risk come up, especially before the last day of the contract. So those type of learning experiences and things are just so valuable for new traders and valuable even for traders for myself that are doing it for a while but aren't that in tune to how covered calls really work and the systems involved in them.
I think one of the advantages that I have in terms of the education is that I started out as a retail investor. You
Right.
know, I've mentioned during the course of our interviews that my first career that I was a dentist and I was doing this just for me and my family. And I never thought that I would change careers to do this, but when the opportunity came by, I decided to do that. And so I'm giving all this education from the perspective of a retail investor and everything that I've learned from that perspective. So I think I've been very fortunate to have that perspective. So I'm able to disseminate this information and have retail investors understand it better. And of course, there are a lot of professionals that follow my work as
Oh
well.
yeah.
But I'm very blessed to have this opportunity to change careers and do something that I love so much.
That's great. Well, why don't you give us the final sort of conclusions here?
Well, okay, so what I want to get across here is that, and this is a phrase you used earlier in our discussion, is that one size does not fit all. Depending on our assessment of the market, our assessment of the chart pattern of the underlying security, our personal risk tolerance, based on all of those factors, we could decide whether we want to enter a trade from a bullish or a more aggressive perspective using out of the money covered calls or from a more defensive perspective we use in bear and volatile markets and use an in the money covered call. And again, the in the money covered call has the advantage of lowering your break even price the most because of that additional intrinsic value component. So make your market assessment, look at the chart pattern of that particular stock, identify your personal risk tolerance, and then make your decision. Am I going to use an out of the money or an in the money strike? And remember, that's called the moneyness of the strike. What is my initial time value return goal range? For me, it's 2 to 4% a month.
Right.
Weekly is just divide that by four. and then that will guide you to the most appropriate strike for that particular trade. And as you pointed out before, and I'm glad that you did this, Howard, you can also ladder those strikes if you're selling multiple contracts. So knowing that information alone will definitely, absolutely 100% bring your total profit level over long term much, much higher than if you just simply did slightly out of the money calls.
Absolutely. And like I said, those all work until they don't, so to speak, is you have to adjust to the market in front of us. It's one of the things I think every educator that I've talked to agrees with is, you can't always be bullish. You can't always be bearish. What you got to do is play the market that's in front of you. And I think that the system you've put in place allows you to do that and allows you to account for whatever you might think the market has in front of us.
Yeah, we haven't even touched on exit strategies, which brings your profit levels up even higher. But disseminating this information incrementally is a good way to do it because I know when we speak, I do throw a lot of information out there, but if your viewers are going to take the time to listen to us talk, then I feel obligated. I know I would want this if I was watching a presentation to get as much information as possible.
Absolutely. I love the way you break it down and do these PowerPoints for us. It makes these go flow so easily. I've actually started to put together a playlist on the Quasar Markets YouTube page that now puts all of your stuff together so people are able to go through and look for very easily because we have hundreds of videos now. But able to find this is the sixth in your segment of interviews so far, and be able to watch them in a half hour each is about what we shoot for. And again, I just want to thank you, Dr. Ellman. I know that I learned so much on these segments, so I know that our viewers are going to get a lot out of it. I want you to have a fantastic week. Enjoy the sun that you're getting down there. We're going to try to hopefully keep the snow away up here up north, and we will see you next week, Dr. Ellman.
Thanks very much, Howard. Appreciate our talks.